Welcome back to the Deep Dive. Today, we were tearing into your stack of materials, and we're focused squarely on commercial real estate and investment strategy. But we're really laser-focused on one particular sector that just keeps popping up everywhere. It's the one that CNBC, I think it was recently called, close to risk-free.
Which is a phrase you just don't hear. I mean, when you're talking about commercial real estate, where everything is about cyclical risk and leverage. Risk-free should, it should immediately grab your attention. It feels like an anomaly.
Absolutely. We are talking about self-storage. And our mission today is pretty simple. We want to unpack the national resilience of this asset class. But more importantly, get into why Indianapolis, Indiana, is being flagged as the absolute prime market for acquisition in 2025. This isn't some broad, abstract story. This is about a specific geographic sweet spot.
And I think the initial shock factor from the data is where you have to start. You really have to forget what you think you know about traditional real estate. Nationally, self-storage has delivered 15 straight years of NOI net operating income outperformance.
15
straight years compared to every other major asset class. We're talking multifamily, industrial, office, retail, all of them.
That is just incredible consistency. I mean, that's over multiple economic cycles.
It's the very definition of stability in a very volatile world. And here's the punchline for anyone looking to invest right now. While the performance has been a flat line of success, the actual asset values are reported to be down about 11% from their peak in 2022.
Okay, so there's a discount.
There's a discount.
Yeah.
That price correction, paired with the reliability of the sector, it creates the best buyer's market we've seen for these facilities in maybe a decade. You get resilience and you get it on sale.
Okay, so let's unpack that resilience.
Yeah.
Why is self-storage consistently defying gravity? Why is it decoupling from the economic forces that just, crush a sector like office? The core reason seems to be this amazing concept of zero economic correlation.
That is the magic ingredient. Zero correlation. It means demand for storage isn't fundamentally tied to GDP growth or the job market or how the economy is doing. It's tied to human life events. We call them the 4 primary demand drivers, and they are basically recession-proof.
4 Ds. I think this is the most memorable part of the entire analysis.
It really is. They are. Divorce, death, downsizing, and dislocation.
Right.
These are, messy, life-changing events that happen no matter what the stock market is doing. And when those 4 things happen, people need a place for their stuff, period.
I have to imagine that dislocation, so that's everything from moving for a job to a flood or something, and especially downsizing, they must spike during uncertain times. When people tighten their belts, they move to smaller places?
Exactly. We see reports of huge spikes in demand right after moments of economic stress. Even seasonally, like after the winter holidays. It's driven almost entirely by increased divorce filings and, the boomer generation speeding up their downsizing plans. The demand just never stops.
Because the human condition doesn't take a break for a recession.
It does not.
So if it's a recession-proof revenue stream, let's talk numbers. What does that operational simplicity do for the financial picture?
The margins are just phenomenal. You're looking at average gross margins running solidly between 60 and 70%.
Wow.
And what's fascinating here is the efficiency, because the product is literally a concrete box with a door. You have almost non-existent tenant improvement costs.
But hang on, doesn't that simplicity make it a commodity? I mean, if it's just a box, why wouldn't massive competition just flood in and drive all the rates down?
Well, that's where the high barrier to entry on the supply side, which we'll get to, meets the fragmented ownership. But just on a fundamental level, it simplifies management so much. Unlike an office building, where you might sink 50 grand into a custom build-out every time a tenant leaves, here, you just need a quick sweep. It's almost hands-off revenue.
And we know the big institutional players are watching. The materials mention that the big REITs, like Public Storage and Extra Space, their stocks are down 16% year-to-date. Yet they're quietly scooping up mom-and-pop facilities. How does that work? Why are their stocks down if the assets are so strong? It seems like a paradox.
It is a paradox, but it's one that smart investors can exploit. Their stock valuations are down mostly because of high interest rates. That affects their cost of capital for future development, not necessarily the performance of their existing assets. So they're leveraging that situation. They're using their access to capital to buy up performing assets at really favorable cap rates, in that 7 to 9% range, while prices are soft.
So the big players are basically using a broad market condition high interest rates to consolidate, buying low while the actual business stays strong. But that brings us to the crucial part of our deep dive. Let's move from the national picture to the local gold mine. We have to stop talking macro. The analysis points overwhelmingly to Indianapolis. Why are Indy's numbers so much better than the already impressive national averages?
Indy is just a massive outperformer, especially in the Midwest. I mean, compared to Chicago or Detroit, it's not even close. The data as of November 2025 shows the metro-wide occupancy rate at a stunning 92.3%.
Wait, 92.3% occupancy, that's functionally full. There's no room for renters. In most markets, 90% is considered stabilized, and that figure is cited as the highest in the entire Midwest.
Correct. And that high occupancy translates directly into huge pricing power. Average street rates are running between $1.38 and $1.62 per square foot. And the climate-controlled units, they're reportedly pushing past $2 a square foot.
And the most important question for an investor, what are we seeing on the cap rate front?
They're high and very attractive. We're seeing 7.2% up to 9.1%.
Okay, so compare that to the national average.
The national average is reportedly around 6.5%. So Indianapolis is offering significantly better yields right now.
That's a huge margin. But usually high cap rates can be a red flag, right? They can signal market risks, maybe a ton of oversupply. Is Indy just building too much storage, like we saw in some of the Sun Belt markets?
And that's the critical difference. The new supply is actually quite low. It's only 4.8 net square feet per capita. That puts it well below those oversupplied markets. So what you have is this perfect storm, contains supply, high demand from the 4Ds, and superior yields.
Okay, but if the yields are so much better, averaging in that 8% range, why hasn't all the national money already flooded in and compressed those cap rates down?
Right.
What's stopping the big institutional guys from seeing this clear inefficiency?
The answer is in the market structure itself. It's just incredibly fragmented. 68% of the facilities are still owned by mom-and-pop operators. Many are retired or getting close, and a lot are using really outdated tech. This creates a massive consolidation opportunity for professional investors to come in, modernize things, and professionalize these assets that are being run inefficiently.
That explains the inefficiency. The big REITs, they want to buy huge portfolios, right? So they leave this smaller, fragmented market open for an individual or a small group.
Exactly. They're often chasing deals over $15 million. That leaves a huge volume of great performing assets under $10 million just sitting there for people who know the local landscape.
This is where it gets really interesting. Let's move past the big metro numbers and dive into the specific neighborhoods. The submarkets that the analysis calls the hot zones for acquisition. You've got 4 key areas.
Okay, let's map this out for you, and we can connect the location to the specific driver. So starting up north, you have Fishers and Geist. These submarkets are leading the pack, an astonishing 94% occupancy, with cap rates between 8.0 and 8.5%.
Hold on, 94%. That's almost impossible. What does that even mean for an investor who wants to buy something there?
It means pricing power and zero leasing risk. The key driver is just massive residential growth. Young families, new home construction. When people move into a new house, they need temporary space for renovations or just to stage their life. The demand there is relentless.
That makes perfect sense. New construction equals new storage demand. Okay, where else?
Next is Carmel and West Carmel. Occupancy is also extremely high, 91%, with caps between 7.5 and 8.0. The key driver here is completely different. It's the boomer downsizing wave. You have older, wealthy residents moving out of these huge suburban homes into smaller condos or retirement communities. Where do all the antiques in the lifetime of accumulated stuff go?
Climate-controlled storage.
Exactly. It's the inverse of the Fishers market. One is growing and needs space for new stuff. The other is shrinking and needs space for old stuff. Both need storage.
Right. And then you shift west.
We shift west to Avon and Brownsburg. Their occupancy is a little lower, 89%, still very stable, but their cap rates are higher, 8.8 to 9.1%. This market is all driven by industrial corridor spillover. Lots of business, construction, trades, all feeding into commercial storage demand, which pushes up the rates.
And the last quadrant.
That would be Westfield and Zionsville. They're at 90% occupancy, with cap rates from 8.3 up to 9.0%. And their driver is simple. It's powerful. It's just unyielding population growth. They're in the fastest growing county in the entire state of Indiana.
It's one thing to see the data, but it's another to see real deals actually closing based on this thesis. You've got some great case studies from late 2025 that really bring this to life. They show the forced appreciation potential.
Let's start with the Fishers example, because it shows the value of just modernizing a dusty old asset. So a 42,000 square foot facility was bought off-market at an 8.9% cap rate. The buyer immediately did two key things: added climate control to some units and installed new app-based access and security.
And the result of that, I mean, an 8.9 cap is already fantastic.
The net operating income was reportedly up 28% in just 90 days.
Wow.
That just speaks volumes about how inefficiently the old mom-and-pop owner was running it. The demand was already there, they just weren't capturing it because they didn't have basic things like a modern gate or climate control.
A 28% NOI jump in 3 months just from changing the locks and adding an app. That's forcing appreciation incredibly fast. And that's why you buy existing, right? No construction delays. What about the Avon example where the cap rates were the highest?
The Avon deal was a portfolio, so 28 units across 3 different locations, all bought from a single retiring owner at a fantastic 9.1% cap. The new owner put in an immediate 12% rent increase across the board, and the tenants accepted it.
Because where else are they going to go?
Exactly. With 89% occupancy, the market can easily bear it because the competition has 0 vacancies.
And then there's that third example in Carmel, which is more of a creative conversion, capitalizing on that boomer demand.
Precisely. This was a challenging one. They took a former big box retail store and turned it into 60,000 square feet of climate-controlled storage. The demand in that area was so intense that the facility was 73% pre-leased before they even finished construction.
Incredible. Just incredible evidence of that pent-up demand. So we've laid out the national resilience, the local outperformance, and the tactical opportunities. Let's tackle the investment question head-on. Looking at 2025, 2026, is self-storage still a good bet in Indianapolis?
The answer from the source material is a definitive yes, and the comparison is what makes it so clear. Stabilized yields are running between 7.5 and 9.1% with almost no vacancy risk. Now compare that to the office sector in the same city, which is dealing with an 18% vacancy rate and constant expensive capital improvements. The stability and the yield in storage just look exceptionally strong.
Which leads right to strategy. Should an investor build new facilities or stick to buying existing ones right now?
The strategic recommendation for 2025 is clearly to buy existing. The reasoning is just pragmatic. It's based on cost. Land and construction costs are still elevated. It's just far more efficient and way less risky to acquire an existing asset at an 8 or 9 cap and force appreciation through those modernization plays we just talked about.
A classic value-add play with a built-in safety net. Much safer than pure development right now. But what's the biggest mistake that investors are reportedly making when they try to enter this space in Indy?
The biggest mistake reported is paying too much attention to the national REIT headlines. They get caught up in the general fear in the macro CRE market, they focus on the big players, and they completely miss the reality of the fragmented local opportunity. The real profit is with those local operators who are ready to retire right now. Those sellers often have messy records, they undermarket their assets, and they're the ones who will sell at those amazing cap rates, the ones you will never, ever find on a national listing service.
So you have to look past the institutional noise and find the deals under the radar, straight from the retiring owners. But is the institutional money going to ruin this party soon?
They are absolutely circling, but the sources confirm that most deals under $10 million are still flying under their radar.
That's the sweet spot.
That's the sweet spot. That under $10 million price point is where individual investors or small groups are still winning these superior yields. Once the institutions really shift their focus there, those yields will compress very, very quickly.
Okay, so let's distill this. For anyone looking at commercial real estate right now, the key takeaway is pretty clear. Self-storage offers high margins, up to 70%, and real economic insulation. Because that demand is just driven relentlessly by the 4 Ds: divorce, death, downsizing, and dislocation.
And Indianapolis is offering the superior local market advantage. It's delivering cap rates between 7.2 and 9.1%. And that's because of that market-leading 92.3% occupancy and a highly fragmented ownership structure that just screams consolidation opportunity.
The window is wide open.
It is wide open right now.
But the sources end with a clear warning. Institutional money is knocking. If these easy 8 and 9% cap rate deals are currently flying under the radar of big money, what does that time-sensitive window imply about future returns and market access?
It implies a definitive sense of urgency. When that institutional money arrives in full force, and it will, and starts aggressively bidding on these same mom-and-pop assets, the opportunity for individual investors to get these outsized returns will diminish significantly. It'll turn from a comfortable buying market into a fierce battleground market, and it'll happen fast. That margin of safety you have in Indianapolis today, it may not exist 6 months from now, something to consider as you look at your next move.